Hello, I'm Stephen Snyder with Georgia Southwestern State University. I have here with me Dr. Randall Valentine, who's a professor in finance, also from Georgia Southwestern. Dr. Valentine, your expertise is in finance, and you wrote a book recently comparing our current economic struggles to the Great Depression, and it's called The Next Great Depression. Tell us a little bit about this book.
Okay, well, where the book originated was during the financial crisis we had a year ago. I was fielding all kinds of calls from, people in the media, from students, from even parents of students, asking me all kinds of questions about, well, how did it get to this point? Can you explain to us what's going on? Can you explain to us, what's going to happen now? I mean, is our money safe in banks? What's going to happen to the banking system? Who's going to be the next bank to fall? And what I decided to do was, after this, crisis had gone on for some time, I decided to write this book to detail several things. Number one, what the parallels are between the Great Depression and what's happening now, and specifically what caused the Great Depression versus what caused the crisis we're in now. And then the second thing I did was the reactions of government intervention and what the government did wrong then and how they're repeating a lot of the same mistakes that they did during the Great Depression.
What put the economy in this difficult situation?
It's a combination of things. What we had going on the same thing that happened in the 1920s, the Roaring Twenties that led up to the Great Depression. We had a lot of that same thing going on now. Specifically, what happened was during that time, the Federal Reserve kept the money supply very, very loose. Now, here's what this means. They kept interest rates artificially low. So in the 1920s, for the first time, people could borrow money to speculatively buy real estate, to buy stocks, to trade any kind of securities, and never before could they do that. Well, what happened is in 1929, the Federal Reserve hikes interest rates, i.e. what they do is they tighten the money supply. And what happens is we see a severe stock market crash because all of a sudden people that had access to easy money didn't have access to easy money anymore. Well, what we had leading up to this was many of the same problems. You had, first of all, an act in 1999 called Gramm-Leach-Bliley. And what Gramm-Leach-Bliley did was it separated, previously during the Great Depression, there was an act called Glass-Steagall, which separated commercial banks, investment banks, and insurance companies. And what ended up happening was, in 1999, they just basically threw this out and said, okay, commercial banks, investment banks, and insurance companies can all be the same institution now. So that's why you can go walk into a bank today and you go walk into your bank and you can buy a life insurance policy. You can trade stocks, you can buy a mutual fund. So that was part of it. The other part of it was the Fed policy that was the same during the 1920s. What the Fed policy essentially did is they kept the money supply very loose. And that's why you saw people buying real estate. That's why you saw people that were, borrowing money to trade in stocks. When money is too loose for too long, it creates bubbles. You saw one in the late 1990s with the stock market bubble because of the internet. And then you saw the real estate bubble, which happened a few years ago. The problem is, with every bubble, the bubble bursts at some point. And the thing is this, had Gramm-Leach-Bliley never been passed, you never have AIG involved in the mortgage market or any kind of derivatives or mortgage-backed securities or anything like that. Merrill Lynch, Bear Stearns, Lehman Brothers, Goldman Sachs, none of these institutions are even involved in this. So we may have a problem, but the problem is not nearly as widespread and it doesn't affect the whole financial sector like this did.
Short answer, what should the U.S. government have done to prevent this crisis?
Okay, first of all, this is the problem with government. We had Glass-Steagall enacted in 1933, which for the better part of 65 years worked pretty well. We never had any large-scale, wide financial crisis like we had during the Great Depression. And it's no coincidence that as soon as they basically say, okay, this law has worked for this long, but now we're going to throw it out. It's no coincidence that all of a sudden we start to have some of the same problems that we had during the Great Depression. So first of all, the government, when they have a law that works, stick with it. Don't try to screw something up that ain't broken. And then the second thing is the government's reaction to this crisis. what happened was the immediate reaction with the TARP and with everything else that happened was we're going to throw money at banks, and we're going to keep the money, and we're going to throw money at banks. And then it's not only enough to throw money at banks, we're going to pass a stimulus package. And the stimulus package is basically the modern version of the New Deal, which did not work during the Great Depression, and it's not going to work now.
Why should somebody buy your book?
If you're curious about what caused the Great Depression, and then what caused this financial crisis, and more importantly, what government did then and what government's doing now. If you're curious about those things, that's one reason to buy the book. But more than it, I would say this. If you're curious about what's going to happen next, if you're curious about, well, you know, where should I invest my money? Is it safe to invest in real estate? Is it safe to invest in stocks? These are all questions that we tackle in the book that we explain in great detail, and specifically what's coming next.
Okay. The book is The Next Great Depression. The author is Randall Valentine, and it's available on Amazon. Go buy it today.